facing development challenges on a global scale.
Today, 40 out of 56 million deaths
are attributable
to non-communicable diseases
such as heart disease, stroke, chronic respiratory disease, and diabetes.
Over 800,000 people
die by suicide every year.
In the Philippines, 5 out of 10 families in 2017
were deprived of basic education.
Nang dahil sa kahirapan, maraming pamilya ang napipilitang pahintuin
sa pag-aaral ng kanilang mga anak.
In remote areas, public transportation is inaccessible.
Children have to cross rivers and climb hills
with their books and bags just to go to school.
Philippines ranked 3rd in the top 10 countries with the most natural disasters for the years 2005 to 2014.
Driven by the goal to achieve sustainable future for all by 2030, the UN identified and adopted 17 Sustainable Development Goals, or SDGs, to address the global challenges we face. This can only be achieved through a collaborative effort of all countries and stakeholders.
Aligned with the ATRAM's mission to engage, inspire, and collaborate
to build a financially secure future,
we are committed to building that future where no one is left behind.
We have adopted 3 out of the 17 SDGs,
aiming to make a positive impact,
as well as ingraining more responsible
and sustainable business practices within ATRAM.
Good health and well-being ensures healthy lifestyle and promotes well-being for all ages. Quality education ensures inclusive and equitable quality education and promotes lifelong learning opportunities for all. Climate action takes urgent action to combat climate change and its adverse impacts. With these goals, a sustainable future is possible, a future where no one is left behind.
The time is now, more than ever, that we must work together
to achieve the global goals in ensuring healthy lives, improving access to education,
and fighting climate crisis.
We at ATRAM declare full support to the UN Sustainable Development Goals. Let's start today. Let's invest in a sustainable future together.
Invest to thrive. Invest together.
Good morning, everyone. I am Pat Muico, Business Development Officer at ATRAM. I'd like to welcome you all to the Philippine Property, Locating Value and Quality, another special webcast as part of ATRAM's exclusive webinar interview series with some of the top business minds in the country. Today, we will be welcoming the President and CEO of Ayala Land, Mr. Bernard Vincent T. Before we begin, I'd like to remind everyone that you may ask questions throughout the discussion by clicking on the Q&A button on your screen. We will get to as many questions as we can at the end of the discussion. Additionally, I'd like to let you know that this webinar will be recorded and the copies will be disseminated within the day, as well as posted on our social media pages. Now, to introduce today's moderator. As ATRAM's head of equities, he oversees the management of domestic equity portfolios, spearheads the development of ATRAM's equity investment process, and periodically shares the firm's outlook on the asset class. However, today, he will be taking charge of this exciting conversation. Let me now hand the floor over to Mr. Julian Tarrobago, Jr.
Thanks, Pat. Good morning, everyone. Super excited for our featured guest for you guys today. As investors, we religiously monitor specific macroeconomic factors. We're focused on this right now and trying to figure out how these affect companies' health, earnings, recovery, and growth outlook given all the uncertainties in the market. Now, while we recognize that there are recent sequential improvements in specific factors like Philippine unemployment and actual growth in OFW remittances, we take this also while taking into account also that we believe the first half corporate earnings numbers or reports were underwhelming. Earnings were down 53%. We actually downgraded our full year forecast for 2020 to a contraction of 40% for earnings. Of course, we anticipate a 45% improvement in earnings in 2021. However, these are all uncertainties that are still in the market right now. Until the uncertainties are lifted, we think there is the risk-return proposition for Philippine equities remains less compelling at this point. But there is long-term value being emerging right now. But this requires a strategy of, at least for us, still elevated cash levels, about 10 to 12%, and really focusing on quality names in terms of the companies and stocks we're investing in. These are companies with healthy balance sheets. We've mentioned this in the past. A clear strategy for emerging stronger, not just surviving the crisis, but emerging stronger, and stocks presenting steep discounts to intrinsic value. Now, that said, as the economy enters a phase of great volatility and uncertainty, you guys, investors and our stakeholders, are asking, is real estate currently a good alternative amidst all of this uncertainty in terms of investing in real estate alternatively as opposed to the traditional stocks and bonds? We think for the right investor, real estate can actually be a good way to generate passive income or create long-term value or long-term returns. And with the equity and bond markets facing alarming levels of volatility, not alarming, but increased levels of volatility right now, it can also be a good property or real estate can also be a good diversifier for a managed portfolio. When stocks or bonds take a downward turn, directly owned real estate doesn't necessarily drop with it, thanks to its low correlation with those markets. So people are asking the question: is now the right time to buy Philippine property? Where do we buy Philippine property? Or if not, how much longer do we think, or do you think the pain or the weakness in the real estate market and the economy will continue? And how do we safeguard our real estate portfolios from all of this uncertainty? Is there a strategy to emerge stronger from all of this? At the end of the day, when considering adding real estate to your investment portfolio, it's, I think, important to be clear on the overall risk tolerance, your overall risk tolerance, and the investment strategy. Now, our featured guest today, I'm sure will help us gain a lot of that clarity. So to help us answer these questions, we are very fortunate, I think it's been mentioned already, to have with us today Bernard Vincent Bobby Dy, the young, vibrant president and CEO of Ayala Land, which is one of the leading and largest property developers in the Philippines. Now, before taking over his role as president and CEO of Ayala Land, Bobby is best known, I think, for successfully spearheading the transformation of a former military base training headquarters in Taguig. You've probably heard of it, into one of the fastest rising and exciting central business districts in Asia, which is today called Bonifacio Global City. So this is the guy responsible for BGC as it is today, for what it is today. Aside from also serving as chairman and president of a whole laundry list of Ayala companies, Bobby is also president of Hero Foundation, Inc., and Bonifacio Art Foundation, Inc., and also he is the vice chair, for all of you golfers out there, of the Junior Golf Foundation of the Philippines. So just to give you an idea, a glimpse of his all-around game. So welcome, Bobby. Really happy to join us today.
Good morning, Jun, and thank you for that very kind introduction. No, but I wouldn't claim the whole credit for the transformation of Bonifacio Global City. Obviously, there are many people involved in making that happen. No? But we're very proud on how that particular development has evolved over the last few years.
It was amazing. I mean, how it's evolved from that military training base into BGC, fondly known as BGC today. So we would love to talk with you about the pain, the uncertainties, and of course the opportunities in real estate, Philippine real estate today. But before that, how are you? How's your family? And what's keeping you busy nowadays?
Yeah, I'm doing well, Jun. Thank you. You know, family's doing also very well. The kids are now back in school through online classes since the ECQ. my schedule has not really changed dramatically. I continue to work basically at the same pace. And since the MECQ, I started going back to the office.
Okay. Have you been watching anything lately on Netflix or whatever?
I recently saw Social Dilemma. No, very disturbing to say the least. And I just also started watching this series titled Occupied, which is a Russian takeover of the Norwegian oil fields. So I just started that the other day.
Okay, I chanced upon this. I was able to watch this short this feature on Netflix. It's called The Short Game. It's about young golfing champions, and you're probably familiar with it because you're actually in it. I saw you in that feature, The Short Game, which is about young golfing champions. And for those who don't know, Bobby, for all of his roles and achievements, is also the loving father of international golf champion Jed D, the Jedi, tawag nila, di ba? So Bob, what's it like to be the father of an international sports champion prodigy?
I'm not sure, Jun, if you want me to get started on this. We might not end this discussion, but I'm really extremely proud actually of both my kids. Jed obviously is better known given his accomplishments in the field of golf. But lesser known is also my daughter, who's just equally talented, Sabrina. I'm really proud of her. She recently just got accepted to Tsinghua University for college, which is the #1 university in China. So she's now slated to start university there. So I'm very proud of both my kids. They're both achievers, but in very different fields. Sabrina academically has been doing quite well. Jed obviously on golf, has really excelled not only locally but also internationally.
Thanks for sharing that, Bob. It's good to know. In the show you guys are featured in, The Short Game, again on Netflix. You can check it out on Netflix. There was a lot of references in terms of how the sport of golf represents the game of life. So I'm curious, for you, what are the main lessons we can all take away from the game of golf and apply into the game of life or leadership?
I'm not a good golfer. No, in fact, actually had to stop playing golf when Jed got really good, just to maintain some respectability with Jed. No, but when you look at golf, when you play the game of golf, obviously there are good days, there are bad days, there are good shots, there are bad shots. So it's reflective of what life is all about. I mean, there'll be good days that you go through. There'll be bad days. I think what's important is how we respond to each situation. No? And what I always tell Jed is, during good days, always act with humility. During difficult shots or difficult days, make sure you act with the grit and determination to be able to bounce back. No? So again, that's similar to life. I think it's important for us to keep that perspective. There will be days where you'll really feel good, but there will be days that you'll feel down. But in all these cases, as you know, during even the difficult situations, it comes to pass. I think what's important is how we react, how we resolve those difficult moments.
Wow. Thanks for sharing that, Bob. Very valuable life lessons. How has that shaped or helped your leadership style? I mean, you're the leaders of one of the largest property developers in the country, and you have a footprint overseas as well. How does this apply to that? How do you apply that to leadership?
Well, it gives me the perspective. I mean, golf is not a game of perfect, and so is life. So difficult moments like what we're facing today, COVID-19, it's important to keep a long-term view. Important to keep perspective that this will also pass. But it's important that we're able to weather the storm. and do everything we can to be able to make sure that we're well positioned to be able to bounce back and to be able to thrive after this particular crisis that we're all facing.
Thanks, Bob. So ironic. I mean, we talked about the show, which was entitled "The Short Game," but you actually preach and live, embody what's it like to the importance of playing the long game, especially I guess in a sector where playing the long game is very important, real estate. So we'll get into all of that. First, let's do maybe a check-in. I talked about briefly about improvements, sequential improvements in the economy. What I'm curious, since we talked about the economy earlier, which macroeconomic factors are you watching very closely, and why?
Well, obviously, first is GDP. Whether it's growth or contraction, it gives us a good indication on economic activity that is actually happening. Secondly, I'll probably look at interest rates, just because we're in the property sector. Values are basically tied to a large extent to interest rates. And third is the unemployment rate. Want to make sure that we're in a situation wherein unemployment continues to improve, and we've seen that. I believe from June to July, we're in an unemployment rate that dropped from 17% to 10%. So it shows us that the economy is improving. So those are probably the three factors that I'll be looking at closely. Maybe we could add also maybe overseas Filipino remittances, again, which has shown some growth again in June and July. And these are all, I guess, positive signs, that somehow the economy is starting to recover.
Thanks, Bob. You mentioned interest rates, and it's what comes to mind is when we had BPI President and CEO Bong Sing in a past episode of this webcast. He did mention that in the property space, low interest rates will be quite supportive of the real estate market. How supportive do you think the current level of interest rates and the current policies of the government will play a factor in terms of how supportive will those factors be in terms of in interest rates, in terms of keeping the real estate or the property sector buoyant amidst all of this uncertainty? Yeah,
I think, Jun, extremely important. There's a very, very high correlation between the level of interest rate or change in interest rate in relation to value of properties. The fact that we're now experiencing near historic lows in terms of interest rate levels has really kept property values at fairly good levels, despite the huge contraction in our economy that we experienced in the second quarter. So when you look at assets, and even you could say that's same for equities, right? I mean, interest rates play a very, very important role in terms of values of equities. So it's similar in the property sector. That's why it's a metric that we watch very closely. We saw, for example, in the late 90s during the Asian financial crisis, where interest rates went up significantly, and that caused a significant decline in property values. In the 2008-2009 global financial crisis, we saw that central banks reacted by lowering interest rates here in the Philippines, as an example, and therefore we did not see a significant decline in terms of values at that point in time. So, it's very important. There's a high correlation between interest rates and property values.
Thanks for that, Bob. It's interesting that you alluded to the past crisis also, because like the 2008 credit crunch and the 97 Asian financial crisis were both linked to heavily linked to the real estate sector in terms of its origins and how it also opened up opportunities for great deals during that period. I mean, when you buy, when I remember speaking with some friends and they were saying, I can't get a good deal on property now because it's not 2008 anymore. Well, guess what? It's almost like we'll see if that happens in terms of real estate prices. But Just want to ask, maybe after talking about the economy earlier, maybe let's do a check-in on the state of the real estate or the property market in the country. How different does the Philippine property sector look for you right now as compared to how it looked at the start of the lockdowns in March?
The first couple of months, when we were on ECQ, were very, very difficult because the economy was basically shut down, except for essential services or essential businesses or essential operations. So there was hardly any economic activity that was happening. If you look at our malls as an example, only the essentials were open: groceries, pharmaceutical pharmacies. So our foot traffic at the time was less than 10%. There was no construction during this period. Okay, so all our construction sites were shut down, and therefore, as you could tell from our second quarter results, there was hardly any revenue recognition for our residential business. You look at hotels and resorts. Again, with the travel ban and basically the economy shut down, I mean, there was hardly any occupancy. But since then, I think things are starting to improve. On residential sales, as an example, in April was a very, very low month for us. But beginning May, we saw a sequential increase in monthly sales. And notwithstanding, when we went back to MECQ in the first 2 weeks of August, that today we're probably looking at reservations anywhere from maybe 60 to 70% of pre-ECQ, which frankly for me is very, very positive. I mean, considering the economic contraction that we experienced in the second quarter. So that's actually very, very positive and to be honest, quite surprising in terms of the kind of resiliency that we've seen so far in the residential segment. In our malls, since the ECQ, when we moved to GCQ, foot traffic continues to improve. We're now looking at foot traffic anywhere from 25 to 35% of pre-ECQ levels, depending on the shopping center that you're looking at. Offices, as you know, Jun, has been fairly resilient. It's not been impacted in any kind of meaningful way so far, and we're hopeful that it will continue to be so. Resorts continue to be hard hit. We just started piloting tourism bubbles in El Nido, but again, these are just few and far between. Our hotels continue to operate, but only really catering to BPO workers and overseas Filipinos who are returning and need to wait until their test results come out. So we're only probably experiencing about 30% of our revenues in hotels compared to pre-ECQ because of the restrictions that we still currently have. So that's kind of like a broad view, depending on the subsector that you're looking at. In summary, residential, I think, is looking fairly positive. Malls are starting to improve. I think still challenge for the hotels and resorts, but the offices continue to be quite resilient.
So thanks, Bob. So it's if I understand you correctly, the sequential improvements have rendered some stability in the real estate market at this point. Is it accurate to say that there is a very, very extremely remote likelihood or possibility of a crash in real estate? I mean, is that a safe assumption at this point? Yeah.
I would think so. One, we've seen an economic crash, in the second quarter. Decline of 16.5% is unprecedented. We've not seen that. Even during the debt crisis that we had in the 80s, we've not seen that kind of economic contraction. The fact that has happened, and residential in particular, property prices continue to hold. They continue to, and this is not just us, Jun. This is the industry, and the industry continues to, move inventory. Is very positive, and as the economy continues to reopen, we're hopeful that things will just continue to improve.
Sure. Thanks, Bob. So just wanted to get that out of the way, that there's a very, very remote, almost unlikely possibility of a crash, and we're seeing some sequential improvements already underway.
I think key, June, is interest rates.
Sure.
Okay. And I think the central bank governor has communicated that we'll be keeping interest rates at these levels, which is I think favorable for the industry. But if interest rates all of a sudden spike, which I don't think anybody's anticipating, then values could be affected.
Right. And I appreciate all the overview that you gave earlier. In order for us to fully understand and make plans moving forward, I think it might help to look at the pain points first. I think you outlined a few pain points earlier. Hospitality and tourism. What are the current occupancy rates in hospitality, and how do you see the opening up? Because people always talk about the cost of closing down, but there's also the cost of opening up or reopening. How do you see this panning out for that particular subsector?
Okay, so I'll do it in two subsectors. So obviously, resorts are different from our hotels, which are primarily located in the city. I think resorts really extremely difficult because we really can't open in any meaningful way. As I've said, we just piloted a tourism bubble in Manilok Island in El Nido, but that's few and far between. So revenues for resorts, are minuscule at this point. Now, for that to recover, I think tourism has to come back in earnest. Now, I know DOT has been working to allow tourism and open in a safe way. I think that's the right approach, but I think it will start first with domestic tourism, and I think from what I read, they're looking at international tourism to open up sometime next year. I think in the second half of next year. So hopefully, when local tourism opens up, then we'll see some gradual improvement in terms of revenues. Now, for hotels, they're primarily located in cities. As I mentioned a while ago, we are actually, based on IATF guidelines, we are accepting basically BPO workers or overseas Filipino residents who are returning and waiting for their test results. And so far, that has allowed us to register around 30% of our pre-COVID, pre-ECQ revenues. And I would anticipate again when things open up and they allow for other sectors or other users to be able to book hotel rooms, then hopefully we could start from this base and then see an improvement. Our main thrust right now, June, to be honest, is to make sure that the people are employed. Okay, so we're reducing rates. We're trying to keep occupancy at a certain level so that we continue to operate. Obviously in some cases maybe closing down might be the cheaper option, but as much as possible, we want to continue to operate so that people are employed. Even if we book losses, we're just targeting to make sure at least we're cash break even. But after you take depreciation, actually these businesses are operating at a loss today.
Thanks, Bob. It's really amazing how your group is consistent in terms of prioritizing the welfare of people, in terms of how you're navigating through all of these uncertainties. Now, another pain point you mentioned is earlier is the malls and retail space. Is your first of all, how is the foot traffic there? Are you seeing any sequential improvement?
Yeah, it's as I mentioned, during ECQ was less than 10%. Okay, when we moved to MECQ, it moved up to around 15%. And then when we moved to GCQ, it moved up to 20 to 30%. But today we're already at about 25 to 35%, depending on the mall. No? So I hope that we're able to continue to reopen the economy, because as we continue to reopen, especially as we approach the Christmas season, then we're hopeful that the foot traffic will continue to improve.
Yes, thank you for that. So is your for managing the mall side or as a mall developer, is your priority now tenancy over revenue? Is that a fair description of your approach? If so, how do you approach this, and are there creative ways to what creative ways are you doing to implement this?
Our number one objective today, June, is to make sure that our merchants remain open, that they survive. That is our number one objective. And therefore, what we've done was during ECQ or when the merchants were closed, we basically waived the rents. So we basically waived, I think, over 5 billion in terms of rental since the ECQ started. Sure. For those who are operating, and we're about, I think, close to about 65% of our merchants are now open, we changed our rental structure during this period. So if you're a food merchant, we're just charging 5% of your sales. If you're a non-food merchant, we're just charging 3% of your sales. And for those who are paying fixed rent, we're basically discounting it by 50%. So obviously we're doing this to make sure that our merchants continue to operate and they survive during this difficult period. But obviously we're taking a hit, in terms of our own revenues. But as I've said, the most important thing right now is to support our merchants.
Thanks, Bob. In some areas, in some countries, I think what the mall developers were doing they were applying the deposits as interim rental payments. Is that something you guys are thinking about as well? Yeah.
No, I think right now so far, at least in the last few months, the fact that we were able to change the rental structure, I think we're able to manage, and our merchants are able to manage within that framework. But obviously, if there's a merchant that is continuing to struggle despite the rental structure that I just mentioned, then we get into a discussion and see what else we can provide, for them to remain open.
Right. Do you have a sense of how supportive banks are with respect to helping these SMEs stay afloat, who happen to be tenants of your malls?
Well, I know, like for us, Ayala, we have a program with BPI. So I can't speak for the banking industry. Are now supportive, but for us, obviously we have some sort of an arrangement or a tie-up with BPI for BPI to help basically our merchants.
Sure, thank you. Okay, last question on the mall space. What is the how do you have a sense of how much mall traffic or mall revenues are affected? This is actually a question from our friend David Lee Chu. How much mall traffic or revenue is affected by online retail? Are you seeing this as a real immediate threat already, or do you see this as something that is going to be more pronounced? I don't know, 3 years from now, because from what we're seeing, it seems like this whole situation has hastened the advent or adoption of e-commerce. I mean, people who I mean, personally, I haven't been really doing a lot of online transactions until recently, and recently I'm amazed at what I've actually been, or my family has been able to purchase online.
Well, without a doubt, June, obviously with the lockdown, people did not have many options. So therefore, the growth of e-commerce basically accelerated during this period. Now, we've always known that e-commerce was going to continue to grow. I think what has happened during this period was what we anticipated will happen maybe in the next 3 to 5 years has actually already happened today. But having said that, even if e-commerce continues to pick up, we feel that the shopping centers or malls will continue to be relevant. Just because in our context here in the Philippines, these spaces are social spaces. Okay, that there is a place for them in our society. People basically use them as recreation and leisure areas. I think what may happen is there may be some changes in the mix, some transformation in terms of what actually is going to be part of the mall, which will, I suspect, be more experiential in nature. So that transformation will just accelerate because of what has happened in COVID. Right. But again, this is not something that has not been anticipated. I think e-commerce is just accelerated, and therefore our transformation will also need to accelerate.
Thanks, Bob. How about logistics? I mean, in some countries, the malls have been converted into pickup points and basically become logistics mediums. Is that something that you're considering also?
I can't imagine a mall like what I've seen in some cases in the US, wherein the whole mall was converted into a logistics center. I can't imagine that happening here. And the reason for that is most of our malls are actually located in highly dense areas.
Sure.
Okay, wherein once, I guess, this health crisis is addressed, that you will have a natural foot traffic, coming in and out of the mall, which is very different from, let's say, a suburban US type of mall.
Right.
Wherein, people go there for a purpose. It's purposeful. That's why they were basically, eaten up by e-commerce. Now, having said that, you could allocate, some space in the mall for a last mile fulfillment center. But I can't imagine, for example, a mall in Makati that we have, let's say Glorieta as an example, or Market in BGC, being completely transformed into a logistics center. I'm not sure if that will be the best use for that particular space.
Sure, thanks. So let's move over into another interesting area of real estate, the residential space. So it seems like it's a buyer's market for now in residential or property. Up to when do you think this is going to last, if ever you agree with it? And second question related to that is, are you seeing some selling pressure from unit buyers wherein they're close to unit turnover? Are you seeing this pressure from them in the secondary market? Is it exerting pressure on prices?
Yeah, no, on the, is it a buyer's market right now? If you mean, let's say developers are a little bit more flexible in terms of accommodating what person's affordability or capability is, then the answer is yes. I mean, we're basically, and I think most developers are, rolling out more flexible payment terms, as an example. Sure. What I've not seen, though, if you say buyer's market in terms of heavy discounting of product, if that's what you mean, then I've not seen that in the market. I've not seen. In fact, in our case, we've not done any kind of mass or wholesale discounting of our products. There may be some cases wherein we're more flexible in terms of payment terms to be able to accommodate the buyer. Now, in the on your second question, on the secondary market, or is there pressure from buyers to sell their unit prior to turnover, and therefore providing some heavy discounting? Again, I've not seen it. I think at the margin, you'll find some opportunities. There may be some individuals who may need some immediate liquidity, and therefore would heavily discount the property. But by and large, I'm not seeing it in a massive scale.
Sure.
And again, my sense is if interest rates continue to be at these levels, I would suspect that we will not see heavy discounting happening in the property market. Again, notwithstanding each individual's needs. Now, obviously, you might see that at the margin there may be individuals who may need immediate cash and therefore are willing to accept a much lower price. How
do you think bank financing is a bit of a constraint right now for access to bank financing is also a constraint for real estate sales nowadays. And another, in terms of constraints, since we're talking about constraints, how much of a constraint also do you think is construction right now, capability?
Jun, I'll talk about at least for Ayala Land. No? We've not seen bank financing as a constraint. In fact, our buyers continue to be financed by the banks with a 10% down payment. No? So, for our own, inventory, we've not seen that. And for our buyers, they continue to be able to avail of bank financing. No? And I think, at least from what I read, I think the banks have capacity. Clearly there's a lot of liquidity in the market. I think the central bank or the monetary board, I think recently, about a month or a couple of months ago, increased the ability of banks to lend. I think previously they had a limit of about 20% of their portfolio allocated to real estate. They increased that to 25%. So I think the banks have a capacity and therefore would have the appetite, to continue to lend. So I don't see bank financing today as a constraint. Now, in terms of construction, obviously it's been very, very challenging, to say the least. Obviously there are new guidelines for construction that include this social distancing, include making sure that people are protected on site through personal protective equipment. Also, you're required to actually provide housing for your workers, on site. So it's been a bit challenging. In our own case, we're fortunate that we have Makati Development Corporation, our 100% subsidiary, in-house, basically do over 90% of our work, and therefore we could deploy a lot easier resources where we feel we need to complete a project faster. So far, pre-ECQ, we had about 60,000 workers in all our sites. Today, we're only able to deploy 20,000 workers. So how are we addressing the difference and make sure that we're still able to deliver on a timely manner? So prior to ECQ, we started this program maybe 3-4 years ago. We started industrializing MDC, meaning to do as much work offsite in a factory. So prefabricated materials. Even now we're able to manufacture a complete bathroom. So because of what has happened, we're going to accelerate the industrialization. Previously, actually, the cost of prefab and doing this offsite is higher than doing it on site. But given the constraints today, I don't think we have any choice but just to accelerate that particular ability, to be able to hopefully construct faster and be able to meet the deadlines for the projects.
Thank you. That prefabrication method was also discussed in our last webcast episode with Edgar Saavedra of Megawide. That's also something that they were doing in a big way.
Our aspiration, June, is, and I've seen this in other countries like in Singapore, that you could actually manufacture a whole unit offsite in a factory and just basically truck it in. It's almost like doing a Lego,
on-site assembly.
So so that's our aspiration. But so far we're making good progress in scaling up our ability to do prefab work.
Sure. Now, one last question on residential, and then we get into another very interesting topic. Office, I think, is quite an enigma nowadays. Last question on residential. Are you seeing in any way, shape, or form, population migration, which is a trend happening outside the Philippines? Population migration outside of the National Capital Region. Are you seeing that in a big way? And if so, what do you think will be the fastest growing cities? And how is Ayala Land positioned to capture that growth?
In terms of population migration, I wouldn't say migration. okay, I would say that the growth rates are actually higher in suburban areas. And this is even before COVID. This has been going on for years. No, I mean, if what you've seen in the National Capital Region, Metro Manila, is the city continues to expand. Okay, so the growth rates outside, like in Cavite, Laguna, Rizal, Batangas, Bulacan, are actually higher than in Metro Manila. Okay, and I think that trend will just continue as we continue to expand, no? As a city. Yeah, just because also the reality is the cost of property in city is getting to be more expensive, no? And therefore a lot of the growth now is being pushed outside of the city. Now it doesn't mean that there's contraction in the city. In fact, city centers like Makati, BGC, and all these other business districts, continue to grow. The fastest growth in terms of what we've seen outside will be in areas like I think Cavite, Laguna, and typically the growth happens where there is infrastructure or soon to be completed infrastructure. As an example, I would expect with the recent opening of Calax, okay, yes, that the areas where there will be exits along that route will grow much faster than other areas. So infrastructure plays a very, very key role.
Thanks, Bobby. So now let's go into office, which is another. So we talked about the pain points earlier. Now let's talk about some areas in real estate property that have proven to be relatively resilient compared to the other subsegments. And this, again, as I mentioned, is office. I'm referring to office. What do you? I could ask about the vacancies or yields, but I'll leave that for later because I want to focus on what I think is more relevant. What do you think will affect office demand the most? Is it the need for more space per employee or less demand due to work from home? Are you seeing shifts in the location of demand as well?
Well, okay. Let me try to give you a perspective of where I think or how office demand will evolve. No? This will just this will be directly tied to our economic growth. Okay, number one. Okay, I think if the economy continues to grow, then demand for office space will continue to grow. Number two, since BPO is a very, very big segment of the office market, what's going to be important there is the wage differential or the I guess cost differential, no, between deploying somebody here in the Philippines compared to, let's say, the United States. In 2018, I saw some data that indicated that a full-time equivalent here in the Philippines costs about $17,000 a year. Okay, compared to the U.S., which is about $70,000 a year, and this is 2018 data. So the U.S. is 4 times more expensive, no, than somebody here in the Philippines. If you have that kind of differential, then it is compelling for people to continue to offshore, their services here in the Philippines. In fact, in our own case, Jun, no, I mean, we continue to grow our portfolio and we continue to close on BPO locators. Just recently, maybe about 4 to 6 weeks ago, we closed a major transaction with a multinational in One Ayala. One Ayala is our development that we're constructing right now in the old Intercontinental site, and we're going to be completing a building in 2022. But already that development we're 2/3 leased out, and as I've said, recently we closed about 10 floors, equivalent to 22,000 square meters, and this just happened over the last 4 to 6 weeks. This is not a relocation. This is basically new shared services facility that will be located here in the Philippines.
So you actually answered my next question, which was why is the BPO sector seeming seemingly having a resurgence. Unless you want to add anything there.
No, I also want to, you touch base on something about, and I know people have been talking about this thing. I wanted to give my thoughts now, which is about,
sure.
Will office space contract because of work from home versus in the office? So my sense is it will be net neutral for most companies. Okay, I think people increasingly are now talking about the need for offices for people to go to offices. I think in the initial part of COVID, or the initial part of the ECQ, people said, "Oh, people can work from home, no need for offices." But I think people are now realizing the need for people to interact, to be together, for innovation, for building a company culture, for productivity. But at the same time, having said that, given social distancing requirements, I can't imagine also people now saying, well, let's increase our office space because of cost concerns. Right. So what will happen probably is a bit of a hybrid. That companies will say, okay, during certain days, team A will come in. During certain days, team B will come in, and therefore, office space requirements for these companies will be net neutral.
Right. So if
that's my sense.
Thank you, Bobby. If it's net neutral, does that mean you don't anticipate a significant increase in vacancy rates? So what's your outlook for how do you see that happening?
I'm not anticipating it, although I'm now hearing some noise in relation to the POGO closures, which account for a little bit over, I think, 10% of the industry space. I think right now the vacancy rates in the industry is probably in the single digits. But clearly, if you add, if POGOs are going to leave, then that will add a significant amount of space into the system.
So you must be a mind reader also, because that was my next question.
Okay.
Yeah, I mean, so do you think there is a more real risk, given the recent pronouncements from, I think, the DOF about some POGOs canceling their contracts? Do you think there's a real risk of them leaving the country? And if so, do you anticipate it to be one shot or in 2 years, or would it be calibrated over 5 years?
I think, June, the risk obviously is there, no? Of POGOs leaving. But I think the risk, and we're seeing, and in our own case, we've not seen any kind of major departures of POGO operators. They continue to operate in our spaces. There are some smaller players who are being consolidated with the biggest player, with the bigger players. The key constraint right now, June, for POGO operators, is the fact that there's a travel ban. Okay, it is the fact that Chinese workers cannot come back. Okay, if you remember, we instituted a travel ban in the first quarter of this year. So many of these workers went back to China during the Chinese New Year, and therefore cannot come back. Okay, and I think that is the main impediment right now. No, that's why you're seeing some closures of POGO, smaller POGO operators. Now, where are they going? They're going to, from what I hear, other countries like Vietnam, Cambodia, Taiwan. But the reality is, in all of these countries, POGOs are not allowed to operate. Okay, Philippines is probably one of the few, if not the only country within the Southeast Asian region that you are allowed to have POGO operators. Now, if you are a POGO operator, would you want to locate in a country where you are illegal, or would you want to locate in a country where you could operate legally? I think the answer is you would prefer to operate in a jurisdiction that you are allowed to operate. So I think my sense is once POGO workers are allowed to come back, if the travel ban is lifted, then I would suspect that any kind of risk will be mitigated.
Sure. Thanks, Bob. So I have a few more questions on opportunities now, and then we'll open up to questions by 12 o'clock. I think we need to extend a little bit because of all the juicy stuff you've been giving us, Bob, and
no problem, Jun.
Hope it's okay with everyone.
Pleasure.
Yeah, you might need to extend to 12:10 if that's possible. So we'll open up to Q&A at 12 o'clock. Right now, I just have a question on everything that's happening right now on the economy and certain subsegments. It's beyond the control of corporates. But for Ayala Land, what are you doing? Again, we're shifting now into opportunities. What is Ayala Land doing proactively to sustain leadership amidst this very fluid environment?
I think first, June, it is important that we continue to serve our customers and the communities where we operate. That is for us the primary concern. Obviously we have our responsibilities, obligations to our customers. And today, top of mind, obviously, is safety. So what we've done is we made sure, or we're ensuring that in all our facilities, that we are stepping up on our safety protocols, and everything is in line with the IATF guidelines. Okay, and in fact, today, in many of our residential developments, we have property managers that stay on site. In fact, we have over 3,000 people in our property management team, APMC, that basically stay on site just to reassure our customers that they're safe. They also don't put themselves at risk by entering and exiting the premises. So that's a primary concern, to make sure that we're able to operate and still provide the service standards that people expect from Ayala. We're also focusing a lot on execution, making sure that we continue to deliver product despite the difficult construction situation that we find ourselves. In fact, over the since the ECQ, we've turned over more than 1,200 units to our buyers. And surprisingly, June, we were able to do this. 56% of them, we were able to do virtually. Okay, so we were able to set up a system wherein actually you could inspect a unit, we'll do a video recording, or we'll with a video, and you could actually zoom in particular areas that you want to focus on, so that we're able to do this contactless. Okay, so that's the first thing, June. I think to make sure that we remain relevant and sustain leadership is we continue to basically serve our customers in accordance to our brand standards and what is expected of Ayala Land. Secondly, we are proud of our organization, our team. That's why a big part of it is to make sure that we protect our employees during this very, very difficult period. Because the bounce back will happen, no doubt. Okay, we want to make sure that our team is intact. Okay, to be able to ramp up quickly and be able to introduce new launches or new product once we see the first signs of economic recovery. So we're doing a lot of things to make sure that our workforce is protected. We're redeploying some to certain areas that they may not have been doing before. So we're doing a few rotations, again, all in the interest of making sure that we keep our workforce intact. And finally, June, I think what's important is we continue to maintain a conservative balance sheet. There's ample liquidity at any point in time. This year we're on track to be able to reduce our leverage. And again, this is all in the spirit of making sure that we are well positioned financially, to be able to weather this crisis and to be able to take advantage of opportunities as they become available.
if Bob, if 2009 presented amazing investment opportunities in real estate, do you think that's also in the works? That could happen right now. I mean, at least given what you know right now and what you can share.
There are always opportunities, June. There are always opportunities out there. In fact, 2009. We look at 2009, right? The opportunity really was not so much that there were properties that were heavily discounted. The opportunity was we went into an unprecedented growth phase in our economy that has happened over the last 10 to 12 years. This has been, at least from my recollection, from my memory, the best economic period that we've experienced. If you're trying to see a period of time wherein you saw, I guess, a significant reduction in prices, then you have to go back to the Asian financial crisis, where we saw a meaningful reduction in property prices during the first 3 or 4 years of the Asian financial crisis.
So 2 last questions, and then we will open up to the floor. First is, what's next for when does Ayala Land get back to 2019 earnings levels? When do you think the recovery would be, or when do you anticipate or think it's going to happen?
The reality is we won't, not just Ayala, but as a country, get into a full-fledged recovery until the health crisis is addressed. Okay, and I think what experts are saying now, what people are saying now, is there's going to be a vaccine sometime next year. So if that happens, then I think the economic recovery will go full speed ahead in 2022. Okay, because unless the health crisis, it's hard to operate when a portion of your economy is not open, when there's restrictions or limitations in terms of mobility. I think the challenge for us now is to make sure we're able to balance, health and the reopening of the economy, so that we mitigate some of the economic pain that we're actually experiencing right now.
Thanks, Bob. So, quick question: what's next in terms of asset injections in AREIT? And lastly, do you have any property investing tips for our audience that you can happily share? Thank you.
Okay, so let me just write it down, June, so I don't forget your question. Sure. So AREIT. Sure. Okay, so we as you know, when we launched it, we injected 3 assets primarily in Makati. So recently, about a week ago, we injected another asset, which is an office building in Cebu, Teleperformance in Cebu. So now, although I'm not at the liberty to disclose, we're now planning a series of injections over the next 12 to 18 months. Our intent, June, is really to keep on growing this vehicle. We feel that it's a very good vehicle, not just only for office buildings. We're now looking at injecting other commercial assets as well. It's a good way to grow the company. It's also a good way for Ayala Land to recycle capital and redeploy into our other initiatives. On your second question about property tip,
Yes, property investing.
I'm not sure, June. I'm really not sure if you want to ask me this question. Okay, that's my tip is to buy Ayala Land property. Okay, my tip is to buy Ayala Land property, June. But let me tell you why. Okay, I mean, I think if you're looking at property, obviously people talk about location, and we talk about location. What you want is an area that will grow economically. I think economic activity drives value of the property. Secondly, obviously you have to take a look at the existing infrastructure as well as the planned infrastructure. I think that will also have a meaningful impact or an impact towards the kind of economic development or economic activity that will happen in that area. And then finally, and this is really very, very important, you have to go with a reputable developer. a developer that has a track record. In our case, if you look at how we develop our communities, our estates, we continue to be present, in the communities that we've developed since Makati. If you look at Makati, we continue to be active in the development of Makati, Bonifacio Global City, Alabang, now the more recent ones like New Valley. So we never really leave a development. We ensure that we continue to participate in terms of management, in terms of governance. And I think that formula has been successful in terms of making sure that the communities remain true to its brand promise and therefore continue to accrete in value. Let me also say, June, that property is probably one of the best investments, if not investment vehicles that's available. No? And I'll cite an example. No? Let's say Ayala Labang. We launched this in 1978, and I think we sold at about 260 pesos per square meter at the time. Today, it's trading at about 100 or over 100,000. If you take a compounded annual growth rate over the last, 42 years, that's about a 15-16% compounded annual growth rate, which is hard to beat. Okay, yeah. I think same thing. You could also argue with the villages in Makati. I'm sure that you'll see a similar profile. So I'm a believer. I'm really a believer in terms of property investment. But you have to have a long-term view. Right. Just like in anything, you could experience some volatility along the way, some excitement. But if you're a long-term investor, I think property is one of the best vehicles.
So play the long game in property. I will read a question from the floor, and I think Philip Hagedorn has a few questions of his own, and I will open up to that. But first, from my friend Steve Manikis, is Ayala land banking as of this time? Is this a good time to land bank?
We continue to look. We continue to look in the market, but so far we've not seen anything yet that we are particularly interested. But we continue to look. But we're not. At least there's nothing that is near consummation.
Thanks, Bob. Phil, you want to ask some questions, or should I just proceed?
Maybe not a question, but just to point out that the returns that we're looking at there for buying property in Makati and other areas. Actually, Bobby, in the last 6-7 years, buying the stock has afforded you almost the same type of return. So just want to let people know out there that one way to play it is to buy Ayala land as well.
I agree,
the
Philip.
taxes are less and the returns are very close.
I agree, Philip. You could choose Ayala land shares or property of Ayala land, Ayala land development.
Well, if you don't have a few 100 million pesos, it's a little hard to buy a Makati property in the village now. So Ayala land might be the option. Yeah. Thank you for joining us today, Bobby.
No, thank you, Philip.
Thank you for the insights.
Thank you.
June, it's all you.
Thanks, Phil. So there's a question on which property segment is the best investment right now, low end or high end? What price range?
Number one, okay, that's a very difficult question. The first thing I would say is, especially when you're buying a home, okay, this is not just a financial investment. Okay, this is an investment for your family. So it's very, very important that you are able to secure the right living environment for your family. This will create priceless memories. No? And again, depending on your affordability, there are various products. As you know, Ayala land, we're a full line. From socialized housing all the way to luxury. It just depends on, I guess, pocket size. No. On what it is that you would want to get yourselves into. But again, the primary purpose of buying this house really is for the family. No? And then I think people who've lived in Ayala land developments, they have very, very good memories. of growing up in those communities.
Thanks, Bob. One last question from the floor. Is co-working space a modern trend? If it is it time to invest in co-working space businesses? Is this the type of business that's resilient to the current crisis conditions?
I think, Jun, it's growing. We have a few, but it's not the dominant leasing model yet for offices. I think as a flex space, it works. I think for smaller companies, for entrepreneurs, I think it works. So it's just a subset of the type of office lease that one could have, depending on your requirements. But it's a growing segment. In fact, it's a fast-growing segment.
Thank you again, Bobby. I'll just integrate our interpretation of what you've said this morning. Is it afternoon already? Noontime, and then we'll get some closing remarks from you. We would appreciate some closing remarks, messages from you. So the real estate sector, and please correct me if our interpretation of what you said is wrong, has been one of the worst hit sectors during past crisis, but Ayala Land's healthy balance sheet and prudent management strategy has allowed you guys to not just weather the storm, but to go above and beyond in terms of employee and tenant welfare and nation building. I mean, the grand scheme. Ali is confident, you're confident that the economy and hence the property sector will bounce back given that interest rates are where they are, quite low, and that you don't think there will be a collapse in the real estate space despite the challenges across subsectors. Your diversification and flexibility allows you to adapt quickly to the shifting consumption patterns. In all this, your well-diversified portfolio puts it in a prime position to not only survive, but emerge stronger. So, do you agree?
Yeah, no, I agree. That's a very good summary. And I just have I guess a few of my own thoughts, just as a closing. I mean,
sure.
Obviously, COVID-19 has hit the property industry hard, as you mentioned, Jun. As it has hit many other industries. It's kind of like one of those once in a lifetime events, but when you look at all crises past, and we could take a look at from the Spanish flu to the Great Depression to World War II to our own debt crisis here in the Philippines, to the Asian financial crisis, to the global financial crisis. Eventually, it ends. All crises end, and when that happens, property sector always bounces back. And it actually has typically a very strong recovery. So despite this crisis, I feel very, very optimistic that once this is over, the property sector will resume its growth trajectory. Here at Ali, as you mentioned, I think we're well positioned to be able to weather the storm. But equally important, I think we are well positioned to resume our usual growth trajectory once this health pandemic is addressed. So Jun, I'd like to thank you and Philip for the invitation here. I'd like to thank everyone who basically joined us in this call.
Thank you so much, Bobby. Thank you so much for joining us and for sharing very generously your insights. Looking to have you back at some point. Meanwhile, thank you everyone for joining us. I will turn over to Pat. Pat, all yours.
Thank you, Jun and Bobby, for your very impactful insights. And to our audience as well. Before we wrap up, I would like to remind everyone that a recording of this webinar will be released to all of you, as well as posted on all our social media pages shortly. As we end this webinar, we will be sending a short survey to get your valuable feedback to ensure that we continue to keep these updates and relevant and useful to you. We hope that you can spend a couple of minutes to answer the survey. We appreciate you for taking time to join us, and on behalf of ATRAM, I would like to wish you all the best of luck. Please stay safe and have a great afternoon.